Okay, great. Thank you for really joining us and going to spend the next 1 hour with us. Good evening, everyone. Today we have more than 100 people joining us today. Really thankful for you to have spent the evening with us. So I'm Janet, the VP of Investment Advisory at StashAway. Today, along with Justin, the head of macro and investment research, today we'll be talking a very critical topic, which is riding the rate, finding opportunities when interest rates fall. Before we start, let's show you. So have some disclaimer. Today we spoke about something is educational and informational purpose. It's not intention to give you any specific advice or recommendation, but feel free to contact us if you have any additional inquiry. Here is our agenda today. We will first we will spend a minute or two to cover who is StashAway for those who are not familiar with us. Then we'll cover the macro outlook, and then we'll look ahead to look for the opportunities. Let's start. So as StashAway, actually, we have Singapore headquarter digital wealth platform. We have operation in 5 markets: Singapore, Malaysia, UAE, Hong Kong, Thailand. We are backed by blue chips investor like Fidelity, Sequoia, Hamilton Link, and we work with a lot of well-known banks as our custodian bank. We are here in Singapore since 2017, so it's about 8 years. And our purpose of being here is to provide a simple, transparent, cost-efficient, and more importantly, intelligent investment solutions to everyone, so that they will be able to be here to manage their wealth in long term. So this is give you take a look like how does it look for those who are familiar with. There's for those who haven't download our app, feel highly encouraged to download it and explore it, play around it. If you have any questions, by all means, anytime can just leave a message while you're downloading and listening to the talk today, or you can always reach out to us on WhatsApp or emails. All right, so let me hand over the slide to Justin to cover the macro outlooks on the interest rates environment. Justin, over to you.
Thanks, Janet. Hi, everyone. Thanks so much for joining us today. Like Janet mentioned, my name is Justin Jimenez, and I'm part of the investment team here at StashAway as the head of macro and investment research. So for today's presentation, I'll be sharing updates on where we are in the macro cycle and what that could mean for investors in fixed income and other asset classes. So just as a reminder, before I begin, if you have any questions, please feel free to shoot them over in the Q&A box in Zoom, or if you're on YouTube, in the chat box there. So first, let's start with this. Where are we now? So, given that, fixed income is an asset class that's really sensitive to economic conditions like growth, like inflation, like interest rates, I wanted to just kick off by setting the stage and sharing where we are in the economic cycle. So at StashAway, how we look at asset allocation is based off of this framework, our economic regime asset allocation framework, also known as ERA, and this is a visual representation of that. So through the framework, we divide up the economic cycle into 4 quadrants along the axes of growth, which is the vertical quadrant, vertical axes there, and inflation, which is the horizontal axis in this diagram. And so what our framework is telling us now is that the regime that we're in is highlighted in orange, and that's a regime of inflationary growth. So in this regime, inflation is high and growth is also in positive territory. So let's use this as a starting point, and I'll sort of dive into each of these axes in the next slide. So first, let's start off with the global growth picture. So this chart, what it shows, the green and red boxes, it's a heat map of the Purchasing Managers Index, or PMIs. This is an indicator that we really like to look at here at StashAway. And these are basically indicators that help to gauge trends in the manufacturing or services sector of an economy to just better understand the economy's health as a whole. So the underlying data here show actually the composite PMI, so a combination of both of those things. Shades of green, those are good. That means sectors are expanding. Shades of red or pink, those are bad. That means that they're contracting. You'll see some gray in October. That means not all the data is out yet. So the big picture here, in 2022, which is on the far left part of this this heat map, you'll see that as the Fed, as other major global central banks aggressively hiked interest rates, as sort of parts of the world also dealt with sort of the lingering effects of COVID, that really weighed on the economy, and that's why you see a lot of red and pink in 2022 and into the start of 2023. Since then, as we've headed into 2024, we've seen that growth has stabilized and the economy has largely held up. So you do see some softness in the Eurozone in pink there, but most importantly, the US economy, the biggest economy in the world, and the global economy, and that's at the top, and the global economy in aggregate are green. And you also see that most major Asian economies are also green. And if you zoom in, if we move on to the next slide, we can zoom into the US. So recently, there's been a lot of focus into the US, and in particular the US labor market, given that the concerns over a rising unemployment rate, meaning that the US economy, for example, could head into recession. And that's particularly important, the employment picture, because the US economy is really consumption driven. So what this chart shows is a breakdown of non-farm payrolls. So this is an employment indicator in the US. Let me bring your focus into the bottom section of this visual. Again, another heat map. Here, green means that the month saw a net increase in jobs. Red means that there were net job losses. Basically, the main takeaway here, the U.S. economy might not necessarily be seeing the supercharged job growth that it had seen over the past few years, but it's still adding jobs on the whole. And not only is it adding jobs, it's relatively broad-based, meaning that you can see job additions across sectors. So that's a broad positive for the U.S. labor market, and also a broad positive for the U.S. economy. If we move on to the next slide, we can see the picture on inflation. So earlier I mentioned that our ERA investment framework puts us in a regime of inflationary growth. So this chart shows the personal consumption expenditures index, or core PCE. Basically, this is a measure of inflation, and the measure of inflation that the Federal Reserve, the U.S. Central Bank, tends to prefer. So this chart further breaks that down into drivers of inflation that are demand-driven. Those are the navy blue lines, and also supply-driven. Those are the light blue bars. You also see a red line across the center. That's the Fed's 2% target. That's where the Fed wants to get inflation. So for our purposes, I think what's really important here is that, the yellow line, which shows the inflation rate in aggregate, it's come down significantly from the highs in 2022 as a result of the Fed's interest rate hikes over the past few years. And why it's come down is because the Fed rate hikes have done their jobs, have done their job, and actually helped to bring down demand. So you can see actually the demand-driven inflation, the navy blue bar, that's been coming down, that's been having like a shrinking contribution over the past sort of year or so. The second thing I want to highlight is the light blue line. So that represents supply-driven inflation, as I mentioned. So that's also come down, but that's still higher than pre-COVID levels. So what this means put together, the Fed will need to be careful in its rate cut cycle in order to prevent from sort of these inflationary pressures from reemerging. So in short, the takeaway from this slide, inflation is still above target. It's nearing target, but it's come down significantly over the past sort of few years. And if we move on to this slide, you'll see that growth, as I mentioned, growth has been holding up, softening a bit, but still okay. Inflation is still above target. It's importantly coming down. So put it together, and what does that mean for interest rates? So let's start with the Fed, the U.S. Central Bank, and how its own members actually see the situation themselves. So the Fed, it has a dual mandate, as sort of a refresher. That means it has two goals. One is to promote maximum employment, and the second is to keep prices or inflation stable. And this slide shows where basically Fed participants, Fed members, see the risks to achieving those goals as of different meetings throughout this year. So unemployment is the left chart, inflation is the right chart. I've highlighted in these yellow boxes where participants or most participants see these indicators likely to move as of the latest meeting in September. So you'll see that by the light blue bars here. And basically, as of that meeting, most Fed members saw that the risks to employment were higher, but also that the risks to inflation were more broadly balanced. So that's kind of a marked shift over the past several months, where the Fed was less worried about unemployment and more worried about inflation. And overall, what this tells us, that the Fed saw inflation coming down to target, but saw risks to employment, and that's why it was able to kick off its interest rate cycle at that meeting in September 2024. So if you move to the next slide, so the previous slide saw where the Fed saw things as of September. So where does it see things going forward? So this chart shows what's called the Fed's dot plot. Each of these dots shows where each of its members see the path of interest rates in the months and years ahead. So the line I want you to focus on is the teal, the light green line, and this tells us what the median participant thinks interest rates are headed over the next sort of months and years ahead. And what they see is that interest rates are going to decrease by about 50 basis points, or 0.5 percentage point this year, and another 100 basis points, or about 1 percentage point next year. And this was as of its September meeting. The dark blue line, on the other hand, is where market participants see the path of rates going forward. It sees, the Fed moving a bit more aggressively this year and next. So it sees, as of that meeting at least, it saw cuts of an additional 25 basis points on top of the Fed's cut, so 75 in total, and an additional 50 basis points next year. So aggregate of about 150 basis points. So why this difference matters is that, given that inflation is still above target and the economy is still doing well, humming along, so that might not necessarily, warrant a more aggressive path of rate cuts that markets had expected. And actually, that's kind of why you've seen in recent weeks that bond prices have adjusted as the market reduced their expectations of rate cuts to be more moderate in line with the Fed's expectations. So that's the Fed. And if we move to the next slide, we'll see the zoom out to the global picture. What the Fed was doing and thinking. What are other global central banks doing? So again, this is another heat map. I like heat maps. This shows the change in central bank policy rates across the world so far this year. Again, green is good. It indicates rate cuts. Red or pink indicates interest rate hikes. And for the see that most central banks have started or are well into their cutting cycles. You'll see that in the bottom half, you'll see emerging economies. Some emerging economies in Latin America are well sort of on their way into the rate cut cycle because of macro conditions in those economies. But you also see a couple of exceptions. So most notably, rates in Japan, those are moving in the opposite direction, and that's because wage growth in Japan has started to finally pick up after a long period of deflation and feed into inflation and inflation expectations. And that's allowed the BOJ to start to increase rates, albeit from a very low level. So main takeaway here, for the most part, global interest rates are largely moving in the same direction, and that's down. I'll take a moment here before I move on to the next section. Again, if you have any questions, please feel free to drop those into the Q&A box in Zoom or in the chat box in YouTube. So let you digest sort of the macro picture. Now I'll sort of shift gears a bit and look into sort of what this picture on growth, what this picture on inflation, what this picture on interest rates means for investors in fixed income and broadly going forward. So on the next slide, this is just sort of a quick slide on bond basics to kind of explain the relationship between interest rates and why falling interest rates in particular are good for bond returns. Basically, that's because bond prices and interest rates have an inverse relationship. So when interest rates rise, bond prices fall. and vice versa. So this occurs because when new bonds are issued at higher interest rates, that makes existing bonds that offer lower coupons or lower interest rates less attractive. So the prices decline so that their yield or yield to maturity can be more comparable relative to newly issued bonds. On the other hand, when interest rates decline, existing bonds that offer higher rates become more valuable, so their prices increase and their yield to maturity decreases. And in the next slide, this sort of illustrates, actually, this is exactly the environment, as I mentioned, that we're in, one of declining interest rates in the US, but also globally. So this chart illustrates basically the total return of the US aggregate bond market after different sort of in the, I guess, 25 months after different rate cut cycles. So depending on, the rate cycle, because each rate cycle is different, the aggregate US bond market gained about up between 10% during the 2019 rate cut cycle and upwards of 20% during the 2001 and 1991 rate cut cycles. So, as I mentioned, each cycle is different, and you'll see different market conditions lead to sort of bumps along the way. But ultimately, as interest rates are cut by central banks, the broad upward path for bonds is the same, and that's upward. So in this sort of next slide, so that was the broad picture. If you sort of go one step deeper and look at sort of the different sectors of bonds, rate cuts are also good across sectors. So, for stocks, people are quite familiar with the different sectors. You have large cap, you have small cap, you have tech, you have utilities, you have different regions. The bond universe also has its own set of flavors, also has its own set of sectors. You have government versus corporate bonds, you have investment grade high yield, bonds of different maturities, etc. And basically what this slide illustrates is how different sectors of the fixed income universe have performed under different interest rate scenarios. You'll see that different sectors do have different sensitivities to changes in interest rates. That's tied to different like their different durations, their different characteristics like credit quality, etc. But if you focus on the navy blue bars in this chart, that illustrates the impact on these different fixed income sectors' returns for a 1% fall in interest rates. And so you'll see across the board that a falling rate environment is one that's sort of best for fixed income returns. If we move on to the next slide, so that previous slide covered return potential. Now let's look at valuation. So how attractively are sort of bonds priced currently? One way you can sort of determine that is to see how bonds are valued, or by looking at their yields relative to their own history. So this chart shows us current yields for different bond sectors. Those are the dark blue diamonds on this chart. And to understand how they're valued or priced, you can compare them to the purple lines, which are their median lines over the last 10 years. So if current yields are higher than the historical median, that means that that suggests that they're still relatively attractively priced. If they're below, that means they're less attractively priced. That's because a higher yield would suggest that the current market value of the bond is lower. So overall, basically what this chart tells us, on the whole, bonds are still reasonably priced relative to history. Now, if we move to the next slide, kind of maybe digging a bit deeper into where we at StashAway see opportunities in different parts of the fixed income universe. So one opportunity we see in fixed income is in shorter dated or shorter duration bonds. That's because the yield curve, it's still inverted and somewhat flat as you go further out. So ultra short and short dated bonds still offer yields above long dated bonds, and you're also not really seeing an incremental yield pickup as you move down the curve. So why you should see that normally is that when you invest in longer dated bonds, these typically should offer a higher yield to compensate for the higher risk that's associated with keeping your investments locked up for a longer time horizon. That sort of normal curve that's illustrated by the gray bar on the bottom of this chart. So you'll see that the yield curve trends incrementally upward. That's the yield curve as of 2020, August 2020, actually. But if you look at the dark blue line, that illustrates the yield curve as it is currently, or as of end September. So as I mentioned, you'll see that shorter dated bonds are still at that point offered yields of 4.7%, higher than other parts of the yield curve. And meanwhile, as you move down the curve, you'll see that bonds, with longer maturities offer lower yields and not much of a pickup as you move further down. So this means that you're not getting that risk premium or additional pickup in yield that would compensate for the additional interest rate risk you take from holding longer dated bonds. So basically, in short, from a duration perspective, we think that investing in shorter dated bonds, given their higher yields and lower risk, still offers a better opportunity from a risk reward perspective. So that was looking at bonds through the lens of duration. On the next slide, we'll turn to credit quality. So in the fixed income universe, so credit quality reflects to the ability of a bond issuer to pay back their debt obligations. So that means paying back the coupons, the sort of interest that they owe to bondholders, paying back their principal at maturity. And based off in that risk spectrum, you have two big buckets actually. One is investment grade, and one is higher yield. So as the yield suggests, high yield bonds offer higher yields to compensate for their higher risk. So as I shared earlier, given where we are in the macro cycle, we're in sort of a period that could potentially look like that's similar to what people call soft landing, where growth is able to sort of come down and not fall into contraction at this point in the cycle. As a result of that, we're seeing that yields for these sorts of bonds, these high yield bonds, they're still relatively compressed or low relative to history. That's illustrated by the blue line in this chart. So the blue line shows sort of the default rate currently, which is about 1.8%, and that's nearly half of its long-term average of about 3.5%. So if you put it together, the yield pickup over investment grade bonds combined with a lower probability of default, given that the economy is still holding up, we think that points to opportunity in higher yielding parts of a fixed income when you take a more holistic risk reward perspective. So again, let me sort of take a quick break, let you digest that, and take this point to give a quick reminder. If you have any questions, feel free to put those into the chat.
Justin, if I can
Yeah.
get in. Actually, it is great to take a break here. So basically, I wanted to share that Justin so far has been sharing with us that some statistic, some data to support that basically interest rate is going to go down. But the question is how fast and how much. So that was the first part of what he was trying to share with us. Then the second part is now that interest rate going down, knowing that if interest rate go down, bond goes up. Now, so we are looking for opportunity in the bond. But among the bonds, it shows that actually across all the subsector is still like when the interest rate go down, they actually have a positive return. Then next, we actually look at the yield in terms of the interest rate. The yield curve actually is higher on the shorter end. And then now the credit rating also show it is a very, very strong economic and with the spread lower. So that's actually where we are considering the opportunities are. And I hope that helps you to digest the whole macro outlook. And feel free to ask any question at this point before we move on to the next part.
Thanks, Janet. No, thanks for that recap.
Yeah,
that was really helpful to digest all of that. Thanks for that. I just have one small section left, and then we can sort of, I guess, move on to your section, Janet. So maybe we can move on to the next slide.
Sorry.
So yeah, so those covered, maybe the shorter sort of view in terms of opportunities in sort of bonds. So I guess what is the longer term, case for investing in bonds? So this chart shows the relationship between the starting yield for U.S. aggregate bonds and the annualized returns over the following 5 years. So each of these colors reflects, a different, data points for different decades. And what you can see for the most part is it's been a relatively close relationship across the decades between starting yield and also subsequent 5 year yields, subsequent returns over the next 5 years. So that's because the starting yield reflects the income that you'll earn from a bond's coupon payment versus its purchase price, assuming you hold that bond to maturity. And as based off of this historical relationship, as the chart points out, as of end September, yields of 4.2% would imply a forward return of roughly the same amount, based off of that statistical relationship. So given that bond yields are still relatively high relative to the past 2 decades, relative to the 2010s, as you can sort of see in this by the orange in that chart, this higher starting point is a good thing for investors if you want to sort of lock in returns over the subsequent period. In this next slide, so that was sort of bonds on their own. If you look at bonds as part of a multi-asset portfolio, they can offer a balancing they can act as a balancing asset and offer stability and diversification to other parts of the portfolio. So this chart looks at total returns, total year-on-year returns actually for the S&P 500. That's in light blue, and for U.S. aggregate bonds, that's in sort of that navy blue. And you'll see that the navy blue representing bonds, that's much less volatile. That's been much less volatile than equities for the past few decades. So during recessionary periods or market drawdowns, that means that bonds have been able to act to dampen volatility and provide diversification to multi-asset sort of portfolios. If you move to the next slide. Again, it's not just bonds where you can see opportunities from interest rate cuts. This chart shows that other asset classes can also benefit. So this chart shows median returns for different asset classes after the start of Fed rate cuts over the last several decades. And you'll see that as time passes, the impact of Fed rate cuts make their way through the economy and through different asset classes. So bonds lead the way. Or have historically led the way, but you can also see that, and that's represented by the sort of navy blue line here. But as time passes, you can also see that historically stocks have gained steam as well as you move further out from the start of a Fed rate cut cycle. And the next slide is just some key takeaways from my section that Janet helped to summarize a bit earlier. So first is that our ERA framework puts us in a regime of inflationary growth. That's one where growth is positive, though softening a bit, and also inflation is above target, but again also cooling. And this environment is what's allowed major global central banks like the Fed to cut interest rates, and rate cut cycles are positive for bond returns across sectors. And as I mentioned in that last slide, additionally, other asset classes as well. So for us, where we see opportunities in the current climate, we think that short duration and higher yielding bond sectors are more attractive from a risk reward perspective. And if you look longer term, there's that close correlation between starting yields and forward returns. That means a higher starting point for yields is better for forward returns if depending on your risk appetite. Finally, as part of a multi-asset portfolio, bonds offer stability and also diversification benefits. So that brings me to the end of my section. Thanks everyone for your attention, and I'll turn over to my colleague Janet to talk more about our sort of product offerings here at StashAway. Thanks everyone.
Thank you, Justin. This is really helpful. And I wanted to also highlight one point is what we call durations. Actually, duration means the sensitivity of the bond movement when the interest rate change 1 basis point. Meaning that like when the interest rate went down, how exactly is the bond going to go up? How much is it going to go up? So when the duration, meaning that the average maturity of the bond portfolios are going to longer, then there is more sensitive to the interest rate movement. And that is one of the reason why when the market sentiments is thinking, oh, we were expecting 50 basis point cut in the beginning of September after the first cut. And then in the middle of October, suddenly maybe a group of people believe, oh, there's actually still some economic data didn't really fully reflected that decision. And then the chances of cutting 50 basis point is no longer as highly expected. Then the market started to take into consideration of this expectation, and that's why the bond price movement would according to this as well. So we will address more about this as well. But I think before we move on to, that's why I think this is one of the when we invest into bond or fixed income, one of the key elements that we will wanted to look at. And this is one of the reasons why we believe that a short-term yield, a short-term bond, short-term duration would be beneficial because the movement, the sensitivity to the interest rate movement would be relatively mild. So, okay, now we have the background, macro background. We have identified the opportunity. So what exactly we can do about it with our portfolios? So I'm going to go through things for what we can offer as StashAway. So now a lot of us actually have been enjoying the high saving deposit rate at the bank, right? And I think until recently now we could still potentially see 2 to 3% if you can get a good deal. But the truth is that actually as we are looking at some references, um, and we see that actually the yield has been is started to come down. And what exactly we consider this is a great reset because 3 years ago, the global central banks, they started to launch this aggressive rate hike campaign. So interest rate actually has been experienced a reset. What does it mean? It means that it's the highest level in nearly the past 25 years. It means for income seeker, they're in a much better position. If you still remember way before 5 years back, when interest rate is close to zero, and as compared to just last year or the year before, that we are enjoying 2, 3, 4% kind of interest rate. Now you will see the main difference. So money really literally would be able to generate income. There are passive income that you can get. But then now, when the interest rate environment is kicking off this falling rate, so this actually create another unique opportunity for investor. And it is very important for us to understand how does it mean to us and where can we position before the actual interest rate go all the way to even lower. So, okay, next I wanted to show you this, this is actually the historical cut-off yield of a 6-month Treasury bill of Singapore from the last year for the past 1 years. As you can see, this is every time when if you're familiar with this, that if you auction for this, and you will get like a 4%, close to 4% last year this time, and then now we're looking at barely about 3%. For this actually is we only people started to know more about it in the Singapore market is only when the interest rate going up 3 years ago. Now a lot of us is actually quite familiar with this, but this actually show us the trend that is coming down, and you wanted to do something before you coming to really down, and then when then other opportunities is no longer viable. Why? Because you can imagine if you're keeping all your money in the bank, it's usually in average Now it's relatively higher, but when it go down, it could go down all the way to 2%, 1%, and there were times that even to below 1% kind of saving rate. So we look at it on a bigger picture. In long run, it can potentially give you an average of 2%. If you're investing every year for 25,000 per year, and in 20 years' time, instead of doing a relatively more conservative bond portfolio, giving you average 4.4%, like a usual global investment grade or like US investment grade or a well-diversified bond portfolio will be able to give you. So you will see actually at least a quarter 25% difference in terms of the return. So that is why we think that you don't want it to add when the options are no longer available, but you wanted to start planning ahead given the information that you have. So for the case of bond, then we now basically from what Justin had mentioned, we think one of the investment instruments that we can go into is the bond. So in a long run, actually, bond entering in a very interesting period. While the current valuation is still attractive, as mentioned by Justin earlier, the long-term expectations that bond doesn't mean it's boring, it doesn't mean that it's not going to move around much. Actually, some of the bond be able to give you a total return of, say, annualized return of 4% for US aggregate bonds, 5 to 6% for US investment grade corporate bond, or 7% for US high yield or emerging markets. This is an annualized return for the past 20 years if you're looking at this sub-asset class of the bond. So then we basically is thinking with now central bank cutting rate, the cash definitely is not going to generate the same kind of attractive yield for you. But at the same time, the bond price actually would go up. There would be potential upside appreciation plus the coupon that you will be collecting from the underlying bonds. So together, we are looking at the total return would be much enhanced return as compared to cash in a medium to long-term perspective. And I think also the last, but basically bond is compared in terms of investment options is provide you a relatively low volatility. And then it would also for some of us who has been investing into equity heavily, when by adding into some fixed income bond portfolio, it helps you to reduce the volatility in as a whole and also give a better risk-adjusted performance. And also one of the reasons is that there are still a lot of uncertainty in the economy. There are different elections is coming. There will be a lot of geographic tensions around the world. So by having a diversified, well-balanced portfolio will help you to ride through the ups and downs and also give you a peace of mind during some volatile market moments. Okay, but then now, so Janet, you speak so much about bond. Then what next? How do I really diversify within bonds? How should we approach it? Actually, like you have just mentioned earlier, there's so many different types of it. They actually react slightly differently, even if the interest rate come down. Different sub-asset class of the bond would react differently, as I will mention that there's different durations and also different credit rating would actually react differently. And also from time to time, even they are all fixed income, they're all bonds. Each of them, when the winners for this year could be the bottom for the next year. So the challenge is like how much and which one should I allocate at different market environments, right? So even after you have chosen the right sub-asset class now, then which exactly bonds should I invest into? And then there's also another consideration of if you wanted to buy into one single bond, the concentration risk and then the minimum sums that you need to buy into a bond, or you even have to be a professional investor or aggregated investor to buy into a bond, actually would stop you from even considering. So, and last but not the least, as we have mentioned a lot, basically they sounds like all US centric. But as an investor in Singapore, we are holding Singaporean dollar. How does that really help us to really generate the return that we want? So another thing is we have to think about is like, okay, now you have holding as US Sing dollar, you're investing in a US dollar bond portfolio, and then the change of the currency would be maybe potentially impact your total return. And that is why we think that when you doing an investment in this particular fixed income, it's better to actually hedge your currency so that we'll be able to control the risk and remove the volatility from FX and the uncertainty. So although it comes with a cost, but actually really helps you to protect the portfolio, deliver a very stable income. Right. So for those who really wanted to do the portfolio by themselves, there's a few things that they need to consider. First, the asset allocation strategy. What kind of duration that you want to look at? As we have pointed out, we currently favored short-term durations. And then in terms of corporate rating, we currently favor in climbing up a little bit under credit ladder, which means that we are considering a high yield, given that the strong economy is supporting low credit default rate. So we wanted to go into up on the ladder, take a little bit of the risk from the high yield and enjoy a higher return, a higher yield to maturity. And emerging market is also is a good time to allocate relatively more as compared to US aggregate bonds. And in terms of security selections, if you really wanted to pick your own bonds, then you need to do some fundamental credit analysis. You need to look at the valuations, technical analysis, and then after that, you have to think about how much to invest. All this actually, sorry. So all this actually has indeed a lot of homework to be done. And for those who actually thinking, not wanting to do all this, that you can actually consider to hire a professional managers to help you to do it. And then they have a big team behind the scenes offering to do all the homework and then study everything, monitoring, and give you to generate a very performing bonds portfolio for you. And as StashAway, how does it really generate the actions that we can really consider? Today, as you look at this slide, it actually show you a lot of different portfolio. And this is exactly, sometimes too many may not be easier for all of you. So that is why we wanted to do all this webinar to share with you where should you focus on. Particularly for today, we want to highlight to you that for people who actually has been doing cash and they're still not quite sure about going straight into a bond portfolio, but they wanted to earn some enhanced yield, they can consider Simple Plus. Simple Plus basically is a portfolio that invests into 3 different mutual funds. 2 of them is an ultra short duration bond, and so far the portfolio has been generate year to date 5.6% total return. This is including the capital appreciation on top of the coupon that is collecting from the underlying bond. Excuse me. So currently, it's a Sing dollar portfolio that giving you a yield to maturity 3.8%, and the volatility is relatively low. So we suggest people who doesn't have up to less than a year investment horizon, they can consider this. And the duration of this portfolio is 1.2 years, which is slightly over a year, around 14 months. Excuse me. And then next, we go into the next we will go into slightly deeper of like the income portfolio, fixed income portfolio. So as StashAway, we have collaborate powered by JP Morgan Asset Management to create this portfolio for you. And then why is it so special about it is because number one, this is a sink hedge portfolio. It really helps you to, eliminate the foreign currency fluctuations from the portfolio. Number two is actually the mandate of it is actually to hold the whole portfolio to have an expected volatility range in 3 to 7%. It means that we are expecting in the long run, the portfolio would not go down uh, more than we are expecting it won't the volatility would not be going down for 70%. And the duration is exactly go into a sweet spot, which where we like is around four years. When the interest rate back then a few years back when the interest rate go down to very close to zero, and that back then the sweet spot of the portfolio duration usually is around 6 to 7%. But today, while the interest rate still going up and we're expecting it going down, the duration currently we are holding is around 4%. So the portfolio has launched in July, and until end of September, the performance has up 3.1%, and annualized return is around 14%. For those who have invested in this portfolio, and rest assured, some of you may have actually encountered some volatility of the portfolio, and it's as what I have mentioned earlier. It was because that when September was actually everybody was so excited and expecting the interest rate is gonna go down, and actually it's cut down 50 bits, which is actually considered a relatively aggressive move. And then the whole market expecting there's gonna be continues to cut another 25 by the rest of the year. So a lot of this expectation is kind of built into the market and also reflected into the bond price. But in the long run, we still believe that the interest rate in the long run, as what Justin had mentioned, 2024, 2025, the rate is going to continue to be as expected in the trajectory to coming down. And with the interest rate coming down, bond price will definitely benefit from it. And that is one of the reasons why this portfolio is meant for hold for like a 3 years kind of duration, so that we'll be able to help you to ride through the cycle and then generate the total return for you in this period. Another good things about getting into a portfolio is that so you have, as you can see, basically you are holding 5 different funds that we have come across different sub-asset class, which is you have corporate high yield bonds, you have US aggregates, you have emerging market portfolio, and then together is a global bond. All this put together is really give you a well-diversified, well-thought, and think about the strategy and allocation in each sub-asset class, each sector. And had just recently in mid-October, the portfolio has re-op from moving 10% from US aggregate to emerging markets debt. So this actually really reflected what happened that we have mentioned. We believe that the opportunities is there, which is you move a little bit up on the credit ladder, so you take a little bit of the risk, and then to enhance the yield, and then at the same time we will remain the durations in the shorter tenure. And then in StashAway, there's another portfolio called flexible portfolio. Basically, this portfolio is giving you the control of how you wanted to do your own allocation with your decisions. And I shortlisted a few underlying ETF to show you with a flexible portfolio, you also be able to identify some fixed income opportunity. So, for example, under the corporate bonds, you would have global government bonds. You have the U.S. Treasury 20 years plus. As you can see here, year to date is currently down 3%. As you can see, the duration is 16 years, which actually reflected to the sensitivity. Again, is a sensitivity for the interest rate movement. So have the reason that just last few weeks in October is actually the market has actually the sentiments and the curve actually has moved, and which actually have impacted the bond price of this in this sector. But if you look at for short duration high yield and high yield US dollar bonds, the duration is around 2 to 3 years. The yield to maturity around 6%. So far, year to date is delivering 6%. All this data is as of end of September, and so as you can see, basically going through different durations and then different sub-asset class, you'll be able to identify the opportunity that invest accordingly. So this is the thing. So Janet, you mentioned that you favor the short duration now. Then when should we go, if interest rate go down, shouldn't we go long duration? And then when should we go long duration? And how long? As in, like, should we go from 2 years to all the way 7 years or all the way to 16 years? So this is exactly where we wanted to monitor the market, understand the macro analysis, get into the data, and then we have to make a decisions when the situations come. Then you have to make the judgments that you have to reallocate or rebalance and reoptimize the whole portfolio. All this sounds very difficult or troublesome or actually a lot of effort. And that is why we really think that having a professional managers to help you to do the corresponding allocation would really help to take away some of your stress or your time, your effort, but you would still be able to deliver the expected returns by going through a bond portfolio. So we wanted to also highlight one asset class that will be as part of the fixed income is the private credit. Private credit is for this case is a alternative investment, is a private market investment. So it's only for the accredited investor only. And accredited investor is in Singapore. Basically, you have an annual income of 300 US Sing dollars, 300,000 Singapore dollar income proof, or you have a 1 million net assets that you will be able to qualify as an accredited investor. But what I wanted to highlight here briefly is that when we consider using alternative investment, it would really help to improve your risk-adjusted returns. So in this graph, what we're trying to say is that this is a typical 60-40 portfolio, which is you have 40% investing into fixed income, 60% invested into equity. And from here, if you're replacing the high yield or bank loans 20% with private credit, your total the portfolio return has improved from around 6.5% to 7.2 to 7.3%. So we have seen a good lift up in terms of the annualized total return, and the standard deviation, which is measuring of the risk of volatility, has actually moved down. So in general, we believe that having a good quality private credits be able to help you to improve your risk-adjusted return. Now, just now, if you remember, there was one of the slides that have mentioned that interest rate come down, not only a fixed income will be benefit from this interest rate falling cycle. In fact, in down the road, once the rate has cut in the next 12 years, we do see a significant upside for equity. But the next is like, so now which equity? How much equity should we allocate? We believe that for this case, we believe that for an investor, they be able to consider adding to some of the equity as part of their total portfolio. So at this slide, we actually want to show you one of the offering is called general investing. Basically, this is the managed portfolio that backed by ERA, Economic Regimes Asset Allocation Framework, as what we have introduced to you earlier by Justin, to show you that for the risk level that you have chosen, there will be a certain allocations that put into it. And this allocation actually take into considerations of the current economics data environment, and also different trends. And we'll put into according to the framework and do the allocation. And also we have an investment team to also review it and we optimize as appropriate from time to time. Here we show it SRI at the bottom of the X asset. What does that mean is that it's a StashAway risk index. It actually is basically is a number that to show you 99% confidence that the whole portfolio would not drop more than 6.5% in the long term. And then correspondingly, if you can take a better risk tolerance, then you can move up to the SRI from 6.5 all the way to 12, and we have the highest level as 36. And what does that mean is that what we believe that actually instead of holding cash, only holding fixed income, for some of those that who actually have a longer investment horizon, and they can potentially be able to have a better tolerance in terms of the movement of the price, they can really consider to add equity into their portfolio. And as you can see, by increasing the equity weighting from 57 to all the way to from 6% equity to all the way to 28% equity, which is less than 1/3, you'll be able to see that the return annualized, this is a return from the last year, from 5% that you can improve to 7.6%. And this is a return in Sing dollar. Okay, so this would be able to give you another options in order to give you a very long-term planning of investment, and how can you also start investing into a well-diversified asset class as well. Now, when let's pause here. So if we remember from the very beginning, we talk about the interest rates falling. We see the opportunity in fixed income particularly, and a particular sector of short durations, and also we are looking at higher credit on the high yield side. And then we also believe that the equity would benefit from the interest rate falling. And we have offered you with 3 particular area. You have Simple Plus for ultra low ultra short durations options. You have well-diversified fixed income portfolio, income investing. You can do your own investing through Flex. And then last but not least, you can do your general investing by adding a little bit of equity and a fixed income at the same time. Now, but for each of you, actually you all have different financial goal. You have a short-term goal, which you may have monies that you wanted to just getting married, putting down on your down payment in a year time. You have some medium goals, which we're talking about 3 to 5 years that you wanted to, just saving or putting aside for some like education fund, or even your long-term goal for your retirement. So all these different goals would directly impact on you which of the solution that you wanted to pick, and how you're gonna and which you're gonna pick. And of course, the risk tolerance is something like whether you really cannot stomach any movement from your portfolio, or actually when you have a longer time horizons, you can just, when the markets went down like 10, 20, 30%, you knew in long run it's gonna go back up. When you have a well-diversified, good allocated portfolio, so you can actually go for a higher aggressive portfolio. But the other way is that you can also do it yourself. Totally fine. So the next thing you need to consider is that you have to consider continue monitorings, or you have to think about optimization from time to time because of the different macro environments, or economic regimes. So then what, of course, we would believe that if you think that doing your own portfolio management is too tiring, and then you wanted to, get somebody to help you. So income investing is a good start from a fixed income, low risk options, and then alternatively, you can choose your own risk tolerant levels using the general investing. Okay, so now I think let me stop here. And we have just passed 8 o'clock. I didn't even notice that, and I I see a lot of questions coming to our chat box and a Q&A. So let's go through them here. So I will can I invite Justine back on the stage, and then let's see how can we answer all these questions.
Sure. Yeah, no, thanks, Janet, for sharing that, and thanks everyone for staying on board and for asking questions that some of the team has already helped to sort of address. So thanks as well to the team behind the scenes for helping that. I'm seeing sort of a couple of questions with a sort of similar theme, and that's sort of recent decline in bond prices that we've seen in the sort of past few weeks. I think what these questions are getting at is, bonds, that volatility that we've seen. And kind of like how I mentioned earlier in the presentation about sort of market expectations of where the Fed is going to cut rates, and also where the Fed itself thought sort of was signaling it was going to cut rates. I think this is, this sort of move or sort of somewhat, these recent moves in bond prices have been kind of like this market repricing, where those sort of two things have come more in line. So why, bond prices have come down, and as a result, sort of yields have popped back up, and not only sort of bonds, but sort of as James asked, interest rate sensitive sectors like REITs. So that's sort of I guess the short term picture. I think what's important is to maybe zoom out to the longer term. For one, the Fed just kicked off its rate cut cycle. So, as it continues to cut, that's supportive of bond returns. And if you look at, I guess, depending on when, I guess you began your investments, and I guess what proportion your investments are in different sort of sectors and different asset classes. Actually, a good amount of fixed income sectors have continued to see positive returns if you zoom out to the year to date. And looking forward, as the Fed continues to cut rates, that should also be supportive of bond returns going forward. So, ultimately, sort of investing is a very personal thing. It depends on your risk profile. So one thing that I mentioned earlier, if you're more, I guess, risk averse and are sort of need that stream of fixed income, there's a strong relationship between starting yields now and forward returns. So that would be one thing to consider going forward. I don't know if Janet, if happy to hear your thoughts. If you have anything else to
No, thank you,
after that.
Justin. I'm still looking for all the questions and see where we can try to answer it. Is there any
Sure.
other questions that which one we addressed?
Okay.
So I think for the Fed cut interest rate in September, why is oh yeah, so this is what I picked, Justin. I saw you have clicked it. With coming rate cut in November and so on, will it help the long-term bond to the price to move back up?
I mean, yes, correct. So like I mentioned, if you so as interest rates continue to come, that should be more beneficial for bonds, especially as the Fed continues its rate cut cycle. So we are seeing some near-term volatility in bond prices. It's not like it can be a bumpy path. So that's why sort of, as I mentioned, sort of the situation currently.
I saw one of the questions that is how long we shall think for bonds, short term versus long terms, or also whether developed markets or emerging markets. Any preference in terms of the bond return? Shall we consider short term due to a long term because we don't know how future may look like in long term? I can answer first, and then maybe Justin, you can help me too. So, as what we have mentioned earlier, so actually in terms of bond investing, we actually would look at the first, when you talk about bond investing, I assume that you're not looking at a single bond, meaning that one issues. we're looking at the bond portfolio. So we are looking at the whole sector. Currently, we would prefer short durations and high yield or emerging market in a way that because that it would actually supported by the current interest rate environment. Second is also the strong economic data that to show that the credit spread has come the credit spread had come at the lowest level, so that it actually help us to show that we're able to give us some expected return from there. But if in terms of personal investment, meaning that is like for your financial goal, that fixed income can always be a part of your core portfolio in terms of holding for achieving your medium to long term. And for the ultra short, sometimes we would consider as part of the either money market fund or ultra short durations fund, which as I has earlier mentioned into a simple plus. That's where actually give you the benefits of the low volatility, so that you can still get an enhanced return, but at the same time you can provide liquidity for you to liquidate, or you can redeem and use the money at your convenience. But given the interest rate environment coming down, if you are keeping too short of a durations, that once the yield interest rate come really down, then you would actually encounter something we call reinvestment risk, meaning that you would have no other when then everything, the opportunities with all has passed away, as in it will be gone, and then you have left with a very lesser options or not as better opportunity as before to go into a position that you like. I'm not sure if I have answered it. Can Justin, maybe you can help me to supplement a bit.
Oh no, I think that covered a lot of bases. So I see that we're sort of running over quite a bit. So maybe we can just answer one last question. I have a question. We have a question from Dimitri, just sort of over the risks that bond prices will keep falling, and sort of that as yields rise, especially as inflationary issues resurface. So, and the sort of second part of the question is, related to the U.S. presidency, which I think is really interesting, given that's coming next week, and the president's plans to run fiscal stimulus and the sort of knock-on effects from in the inflationary pressures. I think I can sort of share a few thoughts here. I think sort of what I shared earlier is, given where we are in the macro environment, there is that risk that inflationary issues could continue to arise, with or without the election, and I think that's why the Fed signaled a more moderate pace of cuts after this year. So signaled 50 basis points this year. That's basically one at the next two meetings. For next year, that's 100 basis points. That's one every quarter. So I think that's a relatively sort of moderate pace of rate cuts, which I think sort of is balancing that need to keep sort of supporting growth, but also prevent inflation from roaring back up again. So there's that. In terms of the impact on the election, I think that there's still a lot we don't know. So one candidate or one commonality of both candidates is that there's an expectation of fiscal stimulus, whether that's through tax cuts, whether that's through sort of incentives or increased spending, which could potentially take knock on or have knock-on effects on inflation. Whether that results in the Fed having to increase rates, again, it's a bit too early to say. That really depends on a number of other factors as well. So that depends on the impact of their other policies, which depends, I guess, who is in the White House. Trump and Harris have their own sort of unique set of policies that could have different impacts on the on sort of the broader macroeconomy as well. So again, we don't know what that will look like until the winning candidate is in the Oval Office. Another important thing to consider is that we don't know what will happen in Congress as well, and that also has an important implications on the impact on the trajectory of policy, and again the impact on inflation. So broadly speaking, I think that's why we can encourage investors to invest in diversified portfolios that match the risk profile. If you're a more conservative investor and are invested in fixed income, that includes investing in different parts of the bond universe, which we do through our sort of lower risk SRI portfolios. Through our sort of high risk portfolios, if you are invested across assets, that could also potentially include other assets like equities, of course, and also gold, which we think is an important balancing asset going forward, given sort of these concerns. So with that, yeah, thanks to Dimitri for your question. I think that was really interesting.
Okay, thank you, Justin. Okay, I have some important information I haven't shared even earlier. So I'm really thankful for those who stay behind. We have like free investing for all of you who attended. So here's the QR code. On your left, you will see you'll be able to book a one-on-one conversation with us. For those that you want to find out more about StashAway, find out more about the portfolio, not even quite clear what I have just said, you wanted to talk to me again. I mean, by all means, scan the QR code and then make appointments. We will arrange. But last but not the least, all the investment that I have just mentioned, other than the private credits, that is all available in SRS, Supplementary Retirement Scheme. And we actually offer a very good, well-diversified options for SRS monies to invest to. Is perfect for your retirement planning options. So stay tuned. We have another sessions about the elections. Once the US elections result is out, we're gonna be talk about what's the impact and what can you position about it. And it will be in early to mid-November after the results is out. And by the end of next month, we will also have a session about SRS as well. So thank you so much for joining us this evening. And I really happy that you stay through the entire sessions, and I wish you well and happy and good evening, everyone. Good night.